All right, so this lecture is going to be about how private equity funds perform. And again, private equity here means leveraged buyout, US, Western Europe. When you don't know, you go to Google and you ask, you search private equity fund. So this is what I did, and here is what I found, examples of what I found. So you have this book, which is an introduction to private equity. So that's, the most fundamental things you need to know about private equity. And the book starts like this. That's the first sentence of the book. Private equity funds have earned a reputation for generating returns above those of public equity markets. Okay, clear statement. First sentence about private equity. And you have all kinds of surveys, like this one that would say that people expect private equity to outperform, like 83% of respondents say it will outperform. And then you have things like when you have trouble, like for a mutual fund or an oil fund, like this one here, the solution usually is that they should invest in private equity because that will give them high returns, and this is what will enable the fund to pay the patients and the like. So that's what you will find all over the internet. The best one I found is an article by the New York Times, relatively recent, written by Dear Professor, like the name. So Dear Professor, in December 2015, writes a paper called Private Equity Fees Are Sky High, Yes, but Look at Those Returns. So that's directly related to what we said this morning. We see that, yeah, there are high fees, but the answer is the returns are amazing, so who cares about the fees? So here's what he writes. He says, critics love to complain about private equity and its exorbitant fees. So I take that a bit personally, but it's okay. But imagine if retail investors, people like you and me, were suddenly allowed to invest in the funds managed by private equity giants like Blackstone, KKR, etc. Imagine that. If all these barriers and regulations came down, you could probably guess what would happen. Hordes would flood the offices of his firms, racing to invest. He would make a Black Friday line at Target look zen. Okay, so it's very clear, right? If people were not restricted to invest in private equity, it would just be masses of money going in there because the returns are just unbelievable. Okay. And the reason is obvious, he says very clearly, as an asset class with the right fund, private equity is unbeatable, well worth the fees paid, period. So as examples in the paper, so this is some of the things he says, like, so you have CalPERS, they earned a lot of money with private equity, so they did pay a lot of fees, but they earned very high returns. And look at Yale. Yale Endowment has earned 36% return. I mean, who beats that? Right? 36% per annum return. And super achievers in the top quartile, including KKR, earn 26% net returns since inception, which is 1976. And Apollo earned 25% return, which I think is since 1991. So these are like extraordinary numbers, right? This is really amazing. Somebody from 1976 to today returning 26% net after fees. You bet people are excited. These are amazing numbers. And of course, the money then just flooding into private equity. Money talks. This is where the money is going. This graph is amazing. You see the growth in assets under management in private equity. It's extraordinary. So this is a slide that I took from actually a senior practitioner in private equity. And he summarized what is the investor's dilemma today. He said, you see, an investor today needs 8% return. Pension funds, like all these guys, they need 8%. And they're not going to get it by investing in fixed income, where you will earn only 2% on expectation. They will not get it with equity. We will expect equity to return 6%. So the only way they can get to 8 is to invest in private equity, where they will earn 17%. And the dilemma of the investor is, what fraction do I allocate to private equity in order to get to 8%? And the answer is 30%. If you invest 30% at 17%, then you get to 8%. Now you may think, well, why not 100% in private equity? Then you get 17%, which is even better than 8. But there is no answer to that question. But so that's how it is portrayed often. But investors need this high rate of return, and private equity will deliver 17%, and so that's why people would put like 1/3 of a portfolio into private equity. So you have these studies, like this one is with McKinsey, Preqin, Cambridge Associates, etc., who said, well, we need to take into account leverage, and if you do that, it's still the case that private equity does better. Now remember this thing that it was actually, it is not easy to beat the index. Most professional investors underperform the S&P 500. That's why you have these sorts of cartoons here saying that studies have shown that monkeys do better than most professionals, and we hire only monkeys. So that's not easy to beat the S&P 500, and private equity seems to have done that by a wide margin. And if you like the mean, you're going to love what is called the top quartile. So the top quartile returns are the ones, the midpoints among the top quartile funds is what is in the red here. And for each vintage year, you see how much the middle upper quartile fund has returned. And so you see 20% plus, a bit below 20, 25, 35, etc. So again, these are like really amazing numbers. The worst year, financial crisis, happening like 2 years down the road, is like 12% for like the average top quartile fund. So these are like extraordinary numbers. This is my favorite picture to illustrate that. But again, was shown by on many occasions by some senior professionals in that industry, and is part of a book called Public Value of Primary and Private Equity. So it's another one of his books that just introduced private equity to the broad public, and that's the first figure that you would see in that book. And it shows you that if you had invested $1,000 in 1980 into the S&P 500, you would have ended up with this minuscule box there. So you'd have given your money to Vanguard S&P 500, you would have ended up with this little thing. If instead you would have given it to private equity, top quartile private equity firms, you would have ended up with this massive box. So you would have given 1,000 in 1980, you would have ended up with 3.8 million as of 2005. So if you would have put 1 million in 1980, you would have been a billionaire by 2005, investing in the average top quartile private equity firms. Now you may say, well, that's great, it's a great return for the top quartile, but how do I know which fund is the top quartile, right? I mean, everything top quartile is doing well, so how do I select top quartile? How do I not end up with a mean? So if you're worried about that, you could hire these guys who says that in their value proposition, they have this expertise based on experience and blah, 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 and the team follows a strategy and selects only top quartile performers. So you could go with a team like that selects for you only top quartile things. Now you may say, well, I don't trust this enough, this is just like, you know, they just claim that, but I don't know. Then I suggest you go for a company called Top Quartile Partners, because if they are called Top Quartile, what else they can deliver? So, so it shouldn't be that hard, right? So. Now, often in the investment world, there is this sentence that people often say is, where are the investors' yachts? So if there has been such high returns, if people would have put $1 million in 1980 and now would be billionaires, where are all these billionaires? Like, show me that people made that kind of money with private equity. And it is indeed difficult often, like, to say, okay, show me some hedge fund investors who became rich. You can name a lot of hedge fund managers who became very rich, but hedge fund investors are a bit harder to find. So in private equity, the answer is always, oh, I know one, Yale endowment, the one that was cited in the New York Times article. So people say, I know where the customer's yacht are in private equity, it's Yale. And this is some extract from the press that would say that you would have like alumni calling up this asset manager, this endowment fund in the US, and say, we are going to be like Yale, right? Meaning you're going to invest massively into private equity, the endowment of this university, in order for us to have a lot more money and to be competing. This is an article by The Economist. That's the beginning of it, that says there can be fashions in investing, like in other things. In the world of investing, it's like the Yale model is the thing, and it has worked very well for Yale, giving returns of 30% since inception. So we hear these numbers, 30%, 38%, 26% for KKR, 22% from Apollo, etc. And they seem quite extraordinary. Who's one of the richest person in the world who happens to be an investor? Warren Buffett. What's the return of Warren Buffett?
26.
It's 20% net of all fees. So all these guys, like the top quartile private equity firms, so it's like 2,000 firms, make a joke of Warren Buffett's track record. Right. Yale made 30% a year, like 50% more than Warren Buffett. This sounds quite extraordinary. How much is it? Like if you take KKR number that was cited in the New York Times paper, the 26% was it? Compounded from 1976 to today, how much would that be? Make that calculation. This is basically, it sounds strange, these numbers are really high. And again, Warren Buffett is the richest guy on the planet with like a 19% net return over a long time period. Okay. The other thing was, an anecdote, I was teaching a Harvard case about the Yale endowment before coming here, and the case was from 2001, and I was teaching about the 30% return of Yale endowment, etc. And when I came here, we had another case updated about Oxford endowment. And that case said, oh, Yale earned like 30% in private equity since inception. And then I went to the case writer and I said, well, be careful, you need to update the numbers. Probably the research assistant that just copied the numbers from the Harvard case, so you need to update these numbers. The Harvard case from 2001, we are now in 2009, so you need to change that number. I said, no, that's the right number. The number hasn't changed since 2001. I don't know, apparently. So then I went to Yale Endowment website and I downloaded all of the annual reports of Yale. They go back to 2000, and from 2000 you can download their annual report. And I put it in the table, which is here. This is their 2000 annual report, annual return since inception, 34%. 2001, they report 33, 31, 31, 30.6, 31, 30.6, 31.4, 31, 30, 30. The number never changes. That's strange. You say, well, maybe because they started so long ago that one more year doesn't move the needle. This is the past 10 years number. 6% over the last 10 years. 30 here, 34 here. You can do it the way you want. This is never going to add up. So that tells you that there is something dodgy with that number. It's implausibly high, way beyond Warren Buffett number. Never changes. And everybody seems to have the same one. 26, 30. So here is a track record. An example of a track record. Where somebody invested in private equity 100, started getting paid back 4 years later, and basically got 2.25 times the money, right, thereafter. And then here says, I have 1,000 of worth of investments, and this is the net cash flows. And what you do is that you go to Excel and then you say, you know, what is the internal rates of return of these net cash flows? And this will be the answer. You get 31%, our favorite number again. This is how much you have invested in total. This is how much has been distributed. Do you think this is a good track record? Yeah, it seems to be a good track record, right? You've more than doubled your money in 4 years on average, which is indeed about a 30% return. You did that over that entire time period. That's indeed about 30% you've earned, and that's a good track record. Okay? That number makes sense. How do you like this one? You return about as much as you have invested. Is that a good track record? No. Do you know what's the internal rates of return of that track record? 31%. Which one of the two is Yale endowment? Don't know. If it's the first one, it's very good. If it's the second one, it's not good. So that's telling me that his number doesn't tell me anything. I don't know if any of these guys are case number 1 versus case number 2. Therefore, I cannot say anything about their returns. That number was empty. And if you remember your Finance 101, you're told not to use internal rates of return. They insist a bit on it, but most people say, yeah, whatever, it's academics. Here you see loud and clear that you should never ever use an internal rate of return because they are completely meaningless. And people use them. And it's misleading. All these numbers in the New York Times are internal rates of return. All the numbers in the Yale Endowment Report are internal rates of return. They are not called like that, they just say returns. Okay? But that's an empty number. I just show you two examples of 2 track records, completely different, and they have the same internal rates of return. So I wrote a paper called, originally it was Is Yale a Model? I was told to be a bit more polite with my title, so I changed it to a more convoluted one. But basically saying a few things. First, someone earning already 30% a year over 38 years, as written in the Yale Endowment Report, would have multiplied money by 24,000. If Yale just had $100 million at inception, by now the private equity alone would be 1 billion times 2,000 something, we would be at 2.4 trillion. Okay? 2.4 trillion is a lot of money. At Yale they pay their academics extremely well and they have fancy buildings, but I think we would have noticed if they had spent 2 trillion plus over that time period. Then the other point of the paper was to point out that a monkey who would have invested in venture capital at the same time would actually have the exact same track record. If you invest in venture capital at the same time as Yale has done so, and you take the average return of the average venture capital funds, and you calculate an internal rates of return, you get 31% return. That doesn't say that Yale was a monkey, I don't know, but the monkey would have the same number if it used the same stupid metric to measure performance. And I predicted that in 20 years' time, the since inception return of Yale will be 30%. and I showed that because what happens with internal rates of return is that it's all about the initial distributions. This 500 received very early on in my example is assumed to have grown at 30% a year forever until the end of your spreadsheet. At that point, 500 growing at 30% is so big that it doesn't matter what happens thereafter, you're done. I could have put on the first one where the track record was 31%, I could add 10,000, 100,000 or 0 as the end value of his fund, it would have made no difference, the internal rate of return wouldn't have changed. It does not matter what happens after, because it's all about the initial cash flows that are assumed to grow at a very high rate, and then you're done forever. That's why from one fund to the other, also like the KKR example and the like, you would find always the same numbers. It was the same number in the late 90s, and it's the same number on the latest fund raised, and say our since inception return is blah, and that's always the same number. Because it's all determined with the early cash flows, and will never change. So I had made that prediction. And I said, and if we want to know if it's case number 1 versus case number 2 that Yale is in, we need to do 2 things. We need to know 2 things. The first one is that you show me venture capital and buyout separately. Because when Yale came in, this is when venture capital gave massive distributions very early on. And if I'm right, then Yale will have a massive return on venture capital, but not in buyout. If it's an internal rate of return, that drives the thing. So that's the first thing that would tell me. And that was weird because in any investor's annual report, or most of them, they would separate venture capital and buyout, but Yale was reporting them together. So I said, if already they split them, it would already be a bit helpful. And the second thing is to show the multiple. So in the first example, it was a multiple of a bit more than 2 times with a 30% return, which is plausible. In the second case, the multiple was basically 1. You return as much money as you took, and it was a 31% IR, and that tells you that this is then a stupid number. So if we know the multiple of Yale, we will be able to know whether it's case number 1 versus case number 2. But they don't report it. So we don't know. And again, there are, the Economist article, etc., saying, look at Yale, this is amazing, this is how they made it, we should all do like them. And yet, we don't know if it's case number 1 versus case number 2. We actually don't know. So that's what I wrote. And from that year on, somehow, by magic, it was a bit covered in the press, the Yale endowment report changed a little bit. So they never did the multiple, but they reported things a bit differently. They did only the past 20 years instead of since inception. They changed things a bit at the margin. Up until last year, where for the first time, Yale separated venture capital from buyout in their annual report. Still haven't reported a multiple, but they separated venture capital and buyout. First time in their 2015 report. So in April 2016, the report is out, and people see for the first time how much money Yale made on the venture capital side versus buyout side. And you bet, on buyout it was a very normal number, like 15% or something like that. And on VC it was 100%. Now play that game of doubling your money every year since inception, you will quickly have, the world GDP and like. So, front page of Fortune magazine and the like, what Yale invested in doubled every year. And then there is this guy who was at the time writing this newsletter for private equity, who's basically the best journalist I know in private equity. Whatever information was needed, like whatever you wanted to know, this guy would always get the information. That's really amazing. And everybody was reading his newsletter. It was like absolutely incredible. So that guy writes that newsletter after the publication of Yale Endowment Report and says, Yale model, 2 dots, has any other pension fund, endowment university, and other limited partner ever matched Yale highly risky but apparently killer track record in venture capital? Yeah, you bet, 100% a year. So since there was a question mark, I thought I should answer. Hi Dan, to answer your Yale question, actually a monkey is starting to invest in venture capital at the same time, and pretending that the since inception IR is the rate of return could actually produce a similar annual report. I particularly love the 93% return over the last 20 years they have in there. If true, they would have had a multiple of 773, their 100 million VC portfolio would have turned into more than the GDP of the US. If true, I think we would have noticed. When will people be serious about measuring performance in private equity? So one thing is that in that industry, apparently, I should not be named, and so I'm academia. Yes, I know a lot of you are questioning this. I don't know who else, but anyway, we will see very quickly that the answer seems to be very specifically targeting my paper and then citing my numbers. So a lot of you are questioning this 93%, particularly given the simultaneous claim of 18% return over the past decade and 34% return since the program in 78. This was my paper that I told you about earlier. This has nothing to do with what Yale has published and so on. So he's citing my paper, but like this is a bit confusing. Like why is it saying that? It's clear that it smells that there's something wrong, but it doesn't know exactly what it is. Fake. And he continues, and then he says, clearly this 93% is probably it's not a compounded figure. Actually, it is. An IR is a compounded figure. Since that would mean that venture capital would have been valued higher than the US GDP. So I don't know if many people had that analogy, but apparently, yeah. So I would guess it's just a reply to my stuff. And it's more likely a dollar weighted number that relies heavily on the dot-com era. Yeah, that's what I explained in my paper. It is indeed. I'm still waiting for details from Yale. So he asked Yale to answer. Now, this research had been covered in the Financial Times, The Economist. They all reached out to Yale Endowment to have an answer, and they never commented. Never gave any answer. That guy got an answer. Okay. 2 days later, say, we've got some clarification from David Swensen. As we suspected, this was an IR. If you suspected that, then you wouldn't have written all the other things above. Fine. Happy you got an answer. So this is the answer And it's an interesting one. The first thing it says, it confirms that this is an IR. So for the first time, we see IR written here. The internet boom has generated triple-digit IRs at the beginning, and we even have like a 700% IR in 2000. Given the mathematics of the IR calculation, the spectacular first 5 years have a significant influence on the IR, which is exactly what we saw in track record number 2. It's all about what happened at the beginning. So he says, yeah, given how an IR works, it just gives like a massive number. But we don't know if the rest stayed good, or whether it's just these ones that are good and the rest was bad, and so it's case number 2. Now, of course, he says, you know, an anomalous period at the beginning will like totally like bias the measure and blah blah blah. Okay, true. And I'm glad you say that it's indeed an IR. You calculate it, because that's not written like that in the annual report. And then he says, in addition to the IR, we consider other measures of returns. We consider multiples and other metrics. That's a very good news. It's just too bad it doesn't find its way in the annual report, because that would have been very handy for the public to know exactly what is your return. So I'm glad that internally you're using the right measures. It's just too bad it's not communicated to the public. And the one that is communicated to the public is a bad one, and a misleading one. But then, he said, that said, we believe that IR, though imperfect, he's not English, but that's a bit of an understatement, are more appropriate than traditional return measures for illiquid portfolios. Really? Why? He says, furthermore, so he doesn't answer that one, he said, furthermore, we need to benchmark our performance, and all the benchmark providers are using IR. So they are using also a silly measure of returns. So in order to have an apple-to-apple comparison, we need to use also something that is very silly. The benchmarks are using a misleading measure, and therefore we're going to use also the same misleading measure in order to do an apple-to-apple comparison. Now, to make it simple, let's just call IR junk. It is a completely random number. You might as well have just invented one. Right? I've just shown you that it can be a poor track record at 31% IR or a great track record 31% IR. So it's like a fake number, junk. And so somebody's saying, the other people are using junk, and so I'm going to use junk so that then it's fair. No, it's not. It's not, because the problem with junk is that it's not comparable to other junk. You cannot rank junk. You can have a track record that is higher than the benchmarks with a lower IR, or you can have the other way around. Okay? Maybe you're above the benchmark with your IR, but given that it is junk, it doesn't tell me if you're already above the benchmark or not. And again, you can have somebody with a 10% IR, which actually has a better track record than the 30% benchmark. So the problem of using junk is that it's not comparable to other junk. Okay? But that's an argument that is often used. Like, everybody else is using junk, so I have to. I'm not sure it's very convincing. So now people say, well, you know, everybody knows these things in practice. Okay, like people just use multiple. So one remark on that is that if people are using multiple, which is the right thing, in conjunction with the junk, why would you using junk anyway? People say, oh, because you see, when it's 31% IR and you see a multiple of 2, it means it's true, it's 31%. But when it is 31% and the multiple is like 1, then you know 31% is not true. Okay, so I have this measure always giving me the right answer, and this measure giving me the answer in about half of the cases, and the other half is extremely misleading. Why do I need to do them both? Why can I not just ban that one and just stick to the good measure? Okay. Now, this is an example where I think that people in practice, at least on that example, do not use multiple and do get seduced by the IR narrative. It's a bit old, but I think it still holds true. This is from the Financial Times in 2002. There is a guy called Guy Hans, who's actually an alumni of this university. He started doing private equity deals in a bank called Nomura. He did 9 deals, starting in 95, and 7 years later, he decides to get out of a bank with his team and to raise his own fund. So first-time fund, had done 9 deals before, over 7 years, comes out, raised his first fund. Okay? That's the newspaper article covering that event. And the journalist says that apparently the rival firms in London, the other private equity firms, seem to be very upset about what's going on here. But he doesn't really, I think, understand what's going on, and he says it highlights the lack of transparency in the industry and blah, blah, blah. There is no problem of transparency because we knew, and he knows, the 7 deals or 9 deals done by Guy Hans. We know the track, we know the performance, we knew everything. So there was no problem of transparency. The problem was that he didn't quite understand what these guys were whining about. So the proof is here. He knew the investments. There was 9 investments made since 95, and it shows a gross annual IR of 62%. Now you multiply, compound 62% for 7 years, you're going to get to something like 30 times your money or something like that. This is a very large rate of return over 7 years. And the multiple is 2. Okay? Which already tells you it doesn't square up. Right? Unless he held things for just like 1.5 years or something like that. These figures are before fees. And rivals do not dispute that the IR is strong. Well, I hope so. Though not the highest. I wish I would have been there when the journalist is told by rivals that the 62% return in private equity is kind of okay. I mean, it's not like the highest thing. We're like, this is like, you know, we have this sort of thing. And this is okay. This is what we do. Okay. And so he said, yeah, okay, they tell me it's not the highest thing. It's not, you know, it's good. 62%, it's good. They challenge the competitiveness of the multiple. So the rivals completely know that. They know this number is junk, so the 62%. But they don't, I'm not going to tell the journalists because they use the same junk to raise money. But just their junk is lower. They have, their IR is 30%. They did the same deals as Guy Hans, but they started earlier. So these massive amounts of money in the mid-90s, like the first deal of Guy Hans, this privatization, comes in a bit in the middle of their track record. So it didn't push their track record so high as it is for Guy Hans, who started with his privatization deal, immediately got a big payout quickly, and then thereafter his IR was set. So these guys have an IR of 30%. So they're a bit upset, because they know it's, you know, it's a trick. So they say, hey, look at the multiple. I think it's important to look at the number too. So the journalist says, okay, apparently it's another measure they look at. Okay, and they tell me the multiple is low. 2 times, it doesn't look that low, but okay, they tell me that. So he details, and the rival says, you see, on the life of a fund, a multiple gross of fees need to be like 2.5 times or 3 times, because it's gross of fees. If you knock out the fees, you are like at 1.8 net of fees. Then that's kind of acceptable. On the 5 years time period, you're looking at 15% net return, which is kind of normal. So people say, you know, the multiple is not that high. He looks like a very normal guy. But the IR is crazy. The highest IR of any European fund. And guess what? Why they were so upset? He raised the largest fund ever in Europe at that point in time. So these guys come out of a bank with just 9 investments, first time fund, and he raises 3 billion, the largest fund ever raised in Europe. So the other guys were mad. We've been around like forever. We do the same things as this guy. Our multiple is better than his. And then they cannot say, look, the IR is not real. Okay, just forget about the number. They cannot say that because they're using it. It's just their junk is lower. Okay. So I find that a very interesting and telling case about this IR versus multiple in practice. Now, you may say, okay, so let's forget the IRs. And how do we measure performance properly? Well, Finance Textbook 101. If you want to know whether a given stream of cash flows have performed better than a benchmark, you need to calculate the net present value. You have a stream of cash flows, you take your benchmark, you discount, and if it's positive, you did better than the benchmark. It is that simple. So we know how to do it. You just need to do NPV, just like a textbook. No IR, use NPV. So there is nothing new here. It's just that outside of private equity, it's not obvious to people why it is so bad. But in private equity, where you can decide, for example, to exit your winners very quickly, you can manipulate that IR. You do like 10 investments, you take the best one, you exit it very quickly, boom, massive cash up front, your IR is set, thereafter you do what you want. Okay? So it's easy then to manipulate an IR and to have a high IR, or to have it by luck, like you start investing in PE and you immediately have this big payout. So the answer, when you do it properly, is that private equity has beaten the S&P 500 by about 3% a year. Okay? And so if you read about any reports nowadays, people will always say, look, there are academic studies, it's 3% above the S&P 500. That's true, I replicated with numbers, 3% above the S&P 500. But private equity investments are not comparable to the S&P 500. 95% of LBO transactions are less than $1 billion of enterprise value. The largest stocks of the bottom 3 deciles in the US have a market cap below 1 billion. It means 70% of the stocks in the US, just their market cap alone is above 1 billion. So the enterprise value is way beyond 1 billion. The S&P 500 is the 500 largest companies. Basically, what are the 4 main components of the S&P 500? Do you know the 4 largest weight in the S&P 500 at present? It's Apple, Amazon, Facebook, and Google. Okay? So when you're telling me this asset class underperformed or overperformed the S&P 500, you're telling me I have an asset class here that has outperformed Apple, Facebook, Google, and Amazon. That's great, except you're just telling me that they have outperformed like a bunch of tech and financial companies, which is what the S&P is, large cap. Why would that be the right benchmark? Why would I be comparing these two things? In some years, tech firms are going to outperform, in some years they're going to underperform. Why is that the benchmark? And the main answer was the S&P 500 had terrible returns, or one possible answer is that it had terrible returns in the 2000s. And so every investment presentation you would sit in would use the S&P 500 as a benchmark. So you would sit in a presentation about investing in gold and say gold has outperformed the S&P 500. Sure, the S&P 500 over that decade did 0, so yeah, everything has outperformed the S&P 500. In fact, 90% of the stocks in the US have outperformed the S&P 500 over that decade. So everybody was using the S&P 500 as a benchmark, I think, because it was the worst benchmark, the one with lowest returns. Now, if you have followed that, the S&P 500 has done pretty well over the last 4 or 5 years. In today's presentations, I don't see the S&P 500 anymore. It's the MSCI World that is used in every investment presentation. And guess what? The last 10 years for the MSCI World, it's been very good. Okay? So, first, there will be no reason to use the S&P 500, and second, it's a very weird comparison given the composition of the S&P 500 and the nature of the companies in the S&P 500. The other reason is that we talked about valuation of companies. You look at comparable companies to value a given investment. So imagine that, so the mid-cap in the US grew at 10% a year, the S&P at 0. The mid-cap grew at 10% a year. Most of private equity investments are mid-cap. Imagine, that's the purpose of the benchmark. Imagine the guys who had no value. They just buy the stock, hold it for 4 years, and then sell it back. What would be the return? 10% a year, because you buy it at a comparable valuations as the others. You hold it for 4 years. If the others have gone up by 10% a year, when you sell it back, you've earned 10% a year, even if you don't do anything. So, it's a bit strange, but then somebody would have done nothing but just buying and holding a mid-cap would be compared to the S&P 500 and say, oh wow, this guy has outperformed the S&P 500 by like a wide margin. Why would you compare these two things? You need to compare, usually when you do benchmarking, to something that was similar to your investment strategy in like the listed space. So if private equity guys buy mid-cap, value, small companies, you compare to the same sorts of companies, the comparable ones that are publicly listed, to see if they have added value compared to very similar companies that are publicly listed. That's usually how you approach benchmarking. And that's not what has been done. Some people have done it. I did. And when you do that, you find that the return of the average LBO fund is exactly equal to the return of mid-cap, value, you name it, indices in that space.
Net of fees?
Net of all fees. And this study has been replicated with better data by a team where some people were at ADIA, some at CPPIB. A group of practitioners, researchers, have replicated these results, showing that if you look at companies that are very similar, so again, value tilt on the small side of the spectrum, you would get the same return with the average buyout fund as you would with a similar listed company. So if you take the S&P 500 as a benchmark, if you insist on that, fair enough, private equity was 3% above. But since 2006 and the S&P 500 doing pretty well, actually private equity and the S&P 500 are equal since 2006. But again, and some people have analyzed this and said, oh, but the returns on private equity are going down because now since 2006 they are equal to the S&P 500. Well, I don't know if it's the returns of private equity went down, or just the S&P 500 went up over that period. It's the wrong benchmark, so that's a time period where tech firms have done well. It doesn't tell me the returns are compressing in private equity. It's telling me that you're comparing to something that has nothing to do with it, and sometimes you're above and sometimes you're below. Okay. So that's an illustration of that. Now you may say, why are investors feeling otherwise? Why aren't people then, are rushing to private equity? We saw this massive amount of money going into private equity. Why is that? The best answer I've got is a report, a very good report, written by this woman at the Kaufman Foundation. And she wrote a report about their true return in venture capital. And Kaufman Foundation is the largest investor in venture capital in the US. And she said, once you do, net present values, we basically underperform the public market. And then if you say, well, then why is that people have a different feeling? And she said, well, investment decisions rely heavily on IR measures that are often misleading. Seductive narratives such as top quartile performance. All these things we've talked about. She says, I think this is why. People are misled by this IR, despite what practitioners say, it's like, oh, but everybody knows. But if everybody knows, then why are you putting this IR on the front page of every single fundraising prospectuses that you send to people? If everybody knows that they shouldn't pay attention to a number. So that's one fairly compelling report, and also highlighting that you need to compare not with the S&P 500, but with small cap, especially if you do venture capital benchmarking. So take home. We saw this morning that fees and costs are huge in private equity. It's an order of magnitude beyond other asset classes. And the usual answer is that, well, it's because they have amazing returns, so who cares? They take these massive amounts of fees, but they have amazing returns. The reality is more nuanced, is that yes, they beat a bit the S&P 500. If you take similar stocks as a benchmark, they are equal after fees. They've done, it's quite remarkable given the size of the fees, that after all these fees, they are just equally performing as much as listed equity. It means that they have generated quite a lot of return before fees. Now the thing as well to know and to highlight is that if you're in a low interest environment and you replicate and you keep a current fee structure, the drag of fees on your gross returns is a lot bigger. We said this morning it's about 6-7% of fees for an average fund. If a fund performs at 18% gross, you knock out the fees, you are 12% net, which is a bit like where we are in the past, for the past data. Going forward, most people would think returns of 10% gross would already be very good. You apply the same fee structure, you go from 10 to 5. And now 5% net for such an investment does seem a bit tricky. Okay? So in a low return environment like this one, the fees will become a bigger problem, and especially the management fees, the fixed part. My proposal is simple. We should just ban IRs. Yale, everyone using it. And use NPV-based measure, just like the textbooks are telling you to do. Okay. So that's a summary of what we just said. If you are a large investor holding the average portfolio of LBOs, you earn like the mid and small cap, which means actually that if you are a large guy, like an ADIA, CPP, IBO of this world, you could make a case that it would be very costly for you to deploy capital in mid cap and small cap, and going via private equity is a more cost-effective way to access this part of the market. A case that has been made recently in Norway with an oil fund who owns like 10,000 stocks around the world, and this is very costly to take such large positions in so many stocks. You may say, okay, then go via private equity funds instead. Even if they're very costly, cost-wise it will still be less than all its price impact and managing a portfolio of 10,000 stocks. Right? So you can make that case for a large guy. For a small guy, it's very tricky to defend investing in the average private equity fund, in the average LBO fund, because then you have proposals like Dimensional Fund Advisor, who gives you access to small cap, mid cap value companies for a fraction of the cost, and that return as much as net of all fees with transparency, etc., as the average LBO fund. So for large guys, you can see that perhaps there is a case. For small guys, it's a very hard case to make, unless you don't invest in the average fund, but the average guy does, okay, by construct. If you're a large guy, however, and it's all about transaction cost, and all you want is access to what we call sometimes this factor or smart beta, to have more of like small cap value companies, if it is what it is about, then there is a cheaper way than going via a private equity fund, and it is like just do it yourself. Just buy companies in that space and just hold them. Okay? And you may say, yeah, that's difficult, it requires skill, etc. You can hire people for that. You can hire people doing due diligence. You can hire people to help you with the capital structure. You can hire this expertise, and you can just hold this company for a long run, etc. So that's something that investors are thinking a lot about nowadays, partly because of the results from these studies that have then been replicated in practice, and then people now starting thinking, yeah, but you know, if it's all about an exposure to that kind of stocks, then and transaction cost is a problem, then there are other ways to do this. Okay. Thank you very much.